HDFC Bank's appetite for loans to the underserved segments may end up raising prices for its competitors. Now, how exactly does this play out? To begin with, there are two key points to remember. Now, first, HDFC Limited, the non-bank housing lender, is in the process of merging with HDFC Bank. The second point here is that banks are required to devote about 40% of their lending to priority sector loans, that is, loans intended for the underserved segments of society. Now, with the merger only a few weeks away, HDFC Bank will need to cover substantial ground on priority sector loans since non-bank lenders such as HDFC Limited are exempted from the requirement. To help it along though, the bank has been granted a few relaxations by the RBI, which basically mean that the bank gets a total period of 4 years to meet the requirement. Now, despite the relaxation, HDFC Bank's hunt for these loans could very well spill over into the root bank stake to cover their shortfalls on priority sector loans. Now, banks typically buy them from other lenders or buy qualified financial instruments that help them meet the gap. Now, HDFC Bank currently gets about 10% of its priority sector loans this way. With the demand from HDFC Bank expected to stay elevated for the next few years, the costs for the entire sector could rise. Now, PSL certificates are one of the qualified instruments used by banks, and they alone are expected to see a price rise of about 100 basis points, according to Pranav Gundlapalle, Senior Research Analyst at Alliance Bernstein. Now, these certificates typically come at a cost of 1% of the total value of certificates purchased. For its part, though, HDFC Bank is pushing the pedal on expanding its own loan sourcing for the segment. The bank's head of commercial and rural banking, Rahul Shukla, told BQ Prime that while the bank will continue to use the inorganic route, the focus will be on organic.
The goal number one is to go organically build. And the distribution reach that we are going after, I alluded to our CRB business in more than 90% of the districts, and at 1.65 lakh villages, wanting to go to more than 2 lakh villages. They're all in the direction of how we organically grow. That's the number one from a prioritization point of view. Do it yourself. It gives you better returns.
A large focus on the inorganic route also negatively impacts a bank's cost-to-income ratio, a measure that compares a bank's operating costs and its operating income. Now, while there are many nitty-gritties to this problem statement, the broad takeaway seems to be dependent on how well HDFC Bank does on the organic front, which could very well determine just how much the costs rise for everyone else. For all the news and updates, keep watching BQ Prime.